Why the Russian economy is surviving sanctions. Despite dire predictions for the severely sanctioned Russian economy, almost 2 months after Russian President Vladimir Putin invaded Ukraine, his country's oil exports to Europe and countries like India and Turkey have increased, and its financial sector has so far avoided a serious liquidity crisis. According to experts, sanctions may be effective in the long run. But for the time being, many of the same nations that are boycotting Russia are nevertheless substantially undermining their efforts by purchasing energy from it, often in amounts that were even higher in April than in March. According to Edward Fishman, a former Europe specialist at the U.S. State Department, Putin continues to earn at least $1 billion a day from the sale of oil and gas, with Europe accounting for the majority of that revenue. Individual European nations do provide military aid to Ukraine, but it is dwarfed by the sums they pay Russia for gas and oil. According to Matt Smith of Kpler, a company that monitors oil cargo ships, oil shipments from Russia increased to 3.6 million barrels per day in April from 3.3 million barrels per day in March, despite Western sanctions on the country's banking sector. The key finding, according to Smith, is that Russian crude oil exports are actually up so far this month compared to last month. It surprises me. Or as experts from the Institute of International Finance put it in a report, Russia's oil shipments in April are so far proceeding at a record pace. Even allowing for the large discount on Russian crude relative to global benchmarks, that means oil export revenues are likely to surpass by a large margin the same month in previous years. Those revenues have driven Russia's current account surplus to new highs. For the first 3 months of the year, it amounted to $60 billion, $83 billion, versus $120 billion for the entire year in 2021, supplying the Kremlin with fresh revenues to counteract the sanctions, even though Russia is far less able to buy supplies and parts from abroad due to sanctions bans. Russia is the world's third biggest producer of crude oil, behind the United States and Saudi Arabia. The precise amount of oil that Russia is now exporting, and to whom, remains in some dispute. Experts say some of that crude is still in transport, in some cases to destinations unknown or to storage facilities. Much of it represents an honoring of long-term oil contracts while a European wind-down is in progress, says Christopher Haynes, an analyst at Energy Aspects, a consulting firm in London. Other energy experts suggest that Moscow is front-loading or boosting exports from existing stockpiles as it anticipates further Western sanctions on oil, and Western countries are snapping them up for the same reason, encouraged by Moscow's sharply discounted prices. Russian refining domestically has actually dropped in the interim, Haynes says. Due to the fact that it is frequently traded on longer-term contracts over fixed pipelines and is less fungible than oil, natural gas is more difficult for many European nations to cut off than oil. The majority of Russian gas continues to flow into Europe as before, despite Germany's announcement shortly after the invasion that the upcoming Nord Stream 2 pipeline from Russia will be stopped. Currently, there are few other sources of liquefied natural gas that can be shipped by sea, particularly in Central and Eastern Europe. It could take years to switch to other major producers like Qatar, Canada, or the United States, which is currently the world's largest natural gas producer. Russia is no. The European Union's Executive Commission has sketched out a plan to slash Russian gas imports by 2/3 by the end of 2022 by importing more liquefied gas and switching to more pipeline gas from Norway and Azerbaijan, as well as stepping up wind and solar. But that plan remains vague, and many experts call it infeasible. It has also met stiff resistance, especially in Germany, which consumes the most Russian gas, amounting to 1/3 of Germany's total annual usage. In a recent interview with Der Spiegel, German Chancellor Olaf Scholz suggested that Berlin couldn't afford to cut off Russian supplies anytime soon, saying an embargo on Russian gas not only wouldn't end the Ukraine war but could lead to a dramatic economic crisis, the loss of millions of jobs and of factories that would never open again. This would have significant ramifications for our nation, for all of Europe, and it would also negatively impact the financing of Ukraine's reconstruction, he continued. Therefore, it is my obligation to state that we must not permit that to occur. Even U.S. Treasury Secretary Janet Yellen stated this week that an embargo on Russian oil and gas could possibly affect Europe significantly, while paradoxically, it could actually have very little negative impact on Russia, as the latter would be able to find clients overseas while raising prices. The only energy exports that Europe has managed to wean itself off to a degree are in coal. Russian Energy Ministry coal official Petr Bobolev told the Duma this week that there has been a 20% decrease in coal exports year-on-year in recent months. US and European officials insist that, in the long run, Putin cannot avoid catastrophic economic fallout from his aggression. The economic crisis Russia faces will leave the Kremlin with fewer resources to prop up the Russian economy, pursue its invasion in Ukraine, and project power in the future, U.S. Deputy Treasury Secretary Wally Adeyemo said on Monday. That may prove true eventually. The Biden administration this week imposed additional sanctions on Russian banks and individuals, following an April 6 announcement of what are known as blocking sanctions on Sberbank and on Alfa Bank, Russia's fourth-largest bank, freezing their assets and barring any U.S. firms from dealing with them. As a result, U.S. sanctions now cover 60% of Russian banking assets, and gradually, Europe is following Washington's lead. Experts anticipate a significant reduction in the amount of credit accessible to Russian citizens and enterprises this year as the country's economy contracts by 8 to 15%. In the long run, some experts predict that Russia's economy will likely contract by a fifth or more over the next few years, given the existing circumstances. That trend will accelerate the longer the war goes on. Western and multinational companies are departing or suspending operations in droves, amounting to some 800 corporations out of 1,200 with operations in Russia so far, according to data from Yale University's Russia Disinvestment Campaign. These include major brand names ranging from IBM and Microsoft to Cargill, as well as many consumer giants such as Kellogg's, Nokia and Panasonic. This in turn has caused what Moscow Mayor Sergei Sobyanin this week admitted was a serious unemployment crisis, saying in a blog post that around 200,000 people are at risk of losing their jobs in the capital. Even in the EU there are stepped-up efforts to halt purchases of Putin's main bread and butter, oil. In mid-March, the giant shipping group Maersk said it had stopped buying Russian oil due to Russia's invasion of Ukraine. Still, for the present, Russia's revenue numbers are telling a very different story, one that reveals just how divided and uncertain the international response really is, and how attractive discounted Russian crude is at a time of rising energy prices and rampant inflation nearly everywhere. Nowhere is that truer than in the energy markets. According to the latest data, Russian crude exports have jumped in the first few weeks of April, with India, Turkey and Italy taking in a lot more, and the rest of the EU pretty flat. While the United States, Britain, Australia and Canada have banned Russian imports outright, most European nations, led by Germany, continue to buy. The biggest percentage increase is from India, which has refused to join in the sanctions or condemn Putin's invasion. Taking advantage of Putin's big discounts in prices, India in just the last 2 months has taken in 17 million barrels of high-grade Urals crude from Russia, the Plur expert Smith says, compared with 12 million for all of last year. New Delhi in the past has bought most of its oil from Middle East producers and Nigeria, but it's now getting a big discount from Russia. Yet, India's intake is still dwarfed by Europe's. Turkey has raised its import of Russian oil up 200,000 barrels a day in March to 300,000 this month, Smith says. Italy is also taking in more Russian crude so far this month, he added, raising its intake from 100,000 barrels a day to 300,000. Some of that crude is headed to European-based refineries still partially owned and controlled by Russia. Since the start of his invasion, Putin has declared to his domestic audience that Western sanctions would only rebound on the United States and Europe because of Russia's huge exports of energy and agricultural goods, causing inflation and economic distress in the West. And indeed, such fears have restrained US President Joe Biden somewhat and dominated the debate so far in European parliaments. As JP Morgan analyst Natasha Koneva said this week, eliminating Russian oil is going to cause every bit of the economic pain that Germany and other EU nations fear, possibly driving up prices by about 65% from about $110 to $185 a barrel. That could be devastating to economies such as Germany's, which gets 25% of its oil and 40% of its gas from Russia. Not surprisingly, Berlin has led the fence sitting over the energy issue. The Biden administration is pushing for a tougher approach but remains leery of getting ahead of the Germans and the EU, seeking to maintain a unified approach. Yet political pressures in the United States are also staying Biden's hand to a degree when it comes to imposing sanctions that would strangle Russia's energy sector. It's Vladimir Putin's gas price increase, Biden said of the pressures at the pump, reiterating his administration's consistent line. Voters have tended to agree in recent polls that Putin and the oil companies bear most of the blame, but they also tend to penalize incumbents for a bad economy, and the Democrats face almost certain defeat in the forthcoming midterms. With inflation at 8.5%, Biden's approval rating dropped to 33% in a Quinnipiac University poll taken earlier in April. The Kremlin has also managed to orchestrate a newly powerful, and unsanctioned, banking center in Gazprombank, the financial arm of Russian energy giant Gazprom. Moscow is pressuring European nations and others to deposit payments in dollars in Gazprombank and receive rubles in return, according to senior U.S. and international officials. And thanks to the deft manipulations of Nabiullina, who has raised rates and imposed currency controls preventing Russians from taking money out of the country, the ruble exchange rate is about where it was in February. The Russian government has also imposed an export surrender provision requiring 80% of the hard currency from exports to be sold through authorized banks, particularly Gazprombank. Inflation in Russia is rising rapidly, with prices climbing more than double digits, but may not exceed 25% by the end of the year, according to various estimates. Sanctioning only some banks, as is now the case, allows Russian energy exports to continue, preserving the current account surplus and Russia's rapid foreign asset accumulation, the Institute of International Finance report said. In other words, existing sanctions are rejiggering foreign asset accumulation, not stopping it. Only an energy embargo or sanctions on all banks will do that. For Putin, the most imminent financial issue is that Russia may soon default on its overseas debt for the first time since the Bolshevik Revolution in 1918, having missed an April 4 deadline to pay in dollars. The country has been given a grace period, but even if it defaults on its $60 billion in sovereign debt, forcing foreign lenders to raise rates, Russia has already been barred from international borrowing and may be able to fund itself with energy revenues for a long time. Meanwhile, doubts remain as to how many international companies are committed to withdrawing from Russia. Some major U.S. companies such as International Paper and Koch Industries continue to operate there, as do a slew of European, Indian and Chinese corporations, including German steel behemoth ThyssenKrupp. Many are using subterfuge to avoid public condemnation, according to Yael Sonnenfeld. Some sectors such as Big Pharma are arguing that they provide essential medicines to Russia, though in many cases they are still selling over-the-counter drugs, he said. Others, including several American food companies, are using the excuse that they are selling nutritional necessities when in fact many of the products are just snack foods, Sonnenfeld says. In all, about 400 multinationals continue to do business in Russia, although some say they are postponing future planned investment, development and marketing or curtailing operations somewhat, Sonnenfeld says. On April 21, Koch Industries updated its policy for operating in Russia, telling employees that its Guardian Glass subsidiary is working with its local management team to find an exit strategy that maintains our commitment to employees' safety and does not result in the Russian government taking over the plants and financially benefiting from them. All other Koch companies, none with operating assets in Russia, have ended or are ending business activities there. Other companies are already trying to get around the Biden administration's ban on investment in Russia, though legal shenanigans, Sonnenfeld says. It's frustrating as hell to see that where there are economic sanctions on future investment, some companies are trying to fool internal regulatory pressure by saying, for example, this is not new plant equipment, instead we're just repairing. For Putin, the biggest question going forward will be whether he can adapt his economy to long-term isolation. Other economies that have faced a similar stranglehold, like Iran's, have done so, and Moscow can keep its banks running a long time on energy-generated subsidies if they become technically insolvent. Russia, unlike Iran, hasn't faced a near-total strangulation of its energy exports. But the denial of Western imports of consumer goods